Hello, this is Nicole. I hope you guys are doing well. It is another bullish day in the markets. Holy smokes. This market is definitely on fire. And there are a lot of positions that are up tremendously over the course of the last few trading sessions. I'm fortunate to have a few positions in a few of these types of securities, one of which is OKLO. I was fortunate enough to purchase 100 shares of OKLO a few months ago at a trade price of just over $49. And we can see here by taking a look at the chart, OKLO has really appreciated in price tremendously over the course of the last week or so, especially over the course of the last, 3 trading sessions. And with that has come a dramatic spike in implied volatility. So you can see here that implied volatility in the blue is trading up near 60%. And when we look back over the course of the last year, we can see that implied volatility was trading at these levels previously. So we're kind of back into the middle of the range here with this. And let me go back to the monitor tab. And we can see that I am sitting on an unrealized gain of 185%, which totals for me a little over $9,000. So I can guarantee you not all my trades look like this, but I'll tell you what, when you have positions that do this well, you need to do things to protect your profits. Okay, because this market is a little bit unusual. Okay, so let's head over to the trade tab and take a look at what I can do here to take advantage of some of this implied volatility. First, I'm going to take a look at the options expiry implied volatility. So this takes the different options expirations and just kind of tells me what those options are doing from a implied volatility standpoint. And you can see here that the implied volatility isn't that different. We're getting some higher values here in the shorter duration expirations. And given what's happening, that's not too much of a surprise. Okay, but overall, nothing crazy is happening here as far as one expiration standing out from the other. Of course, these implied volatilities are very heightened, so that part might look a little crazy to you guys. But as far as one expiration sticking out compared to the other, I'm not seeing anything dramatic. Okay, so let's take a look at the October 17th, 2025 options expiration cycle. These options expire in 25 days. And I want to take a look at implied volatility here on the call side. And this is a little unusual for equity options in that implied volatility is actually going up as the strike price goes up. And that's unusual. Normally, implied volatility goes down as the strike price goes up because we're usually looking at put skew. The risk of a swift downward move is higher in the eyes of the options market relative to an up move. Now, in this case, that is not happening. Okay, so, I have 100 shares and I am long-term bullish on this OKLO. It's a very speculative play. I have a very small position in it, but I am sitting on those gains and it would be a bummer to see those just kind of dissipate if the market did an about face and, corrected down as swiftly as it went up. So let's say that I am interested in possibly selling the 200 strike call option, and that's as high as I can go. I can't go higher. They aren't listing options in this expiration higher than 200. And this particular call option is trading at an implied volatility of 145%. So if I were to sell this call option, the worst possible credit I could receive is $5.60. Now, I want to turn around and see if I can purchase a put option to enter into a cashless collar trade, with the whole point being to protect my downside and kind of lock in gains. So I'm going to scroll down on the put side here, and we can see that implied volatility on the put side is actually going down a little bit as you get further out of the money. So there's definitely call skew in these options. Okay, so I'm going to scroll down and I'm looking to purchase a put somewhere around $5.60. And the 110 strike put option fits the bill here. It's not exact, but it's pretty close. So if I go ahead and populate purchasing the 110 strike put, we can see here that I could put on that collar trade for an 8-cent debit. Okay, and that would give me protection to the downside below $110 per share, but it would cap my gains above $200 per share. So I need to ask myself, is that worth it for me? And if on October 17th, 2025, OKLO is trading above 200, this caller position is going to show a loss against my 100 shares. And at that time, I would have to decide, do I buy back the caller, okay, for a loss and allow my shares to continue to run? Or do I just let the position get called away and be thrilled with the amount of money I just made on a very small trade? I don't know. I'll tell you what, this position is very small for me, and I entered into it with the mindset that this was going to be a buy and hold for the long term. If I owned 200 shares of OKLO, I'll tell you what I would be doing. I would probably be looking at selling a closer to the money call option, maybe the 170 against one of the 200 shares, 100 of the 200 shares that I would theoretically own in this scenario. And I would turn around and I would look at probably buying 2 of the 110 puts. And that's a trade structure that I've done before in scenarios like this. And so hypothetically, if I own 200 shares of OKLO, I would probably, that would give me some flexibility. So in a scenario like this, if I owned 200 shares of OKLO or more, entering into a structure like this would give me quite a bit of flexibility in terms of how to manage the position. So I just wanted to hop on and illustrate this as an example. We don't see this kind of stuff that often. It's a great learning tool, and I hope you guys are really doing well in this market and that you're able to participate in some of these moves in a beneficial way. Happy to have you here, and I hope you're all doing well. Thanks for watching. Hello, this is Nicole, and I wanted to give an update on the collared OKLO position. I was fortunate enough to be able to collar my position in OKLO 2 trading days ago on its epic run to the upside. And since the run, it has had a somewhat dramatic pullback, hitting lows near the $110 mark as of this morning. So let's review my position. I am long 100 shares of OKLO at a trade price of $49.03. I was able to purchase a 110 put and sell a 200 strike call option to finance that put for almost a cashless collar position. And with the selling, the 200 strike call option is profitable by about 90%, and it's only worth about $63 for an unrealized gain of $534. So I'm interested in buying back that short call position because it is not worth keeping it on. So let's see here if I can get filled. It looks like the bid-ask spreads are a little bit wide for that call. Okay, a little bit of time has passed, and I did get filled on the 200 strike call option that I wanted to buy back, and I am long 100 shares of OKLO, and I'm long a 110 strike put option. OKLO is currently trading at $119 per share. So I'm interested in rolling up the put option and financing that roll with the sale of an additional call against the 100 shares, just to lock in a little bit more profit on that position in the event that OKLO continues to fall in price. So before I do that, let's see what the options market is pricing into the upside for this stock. I'm going to take the at-the-money straddle, and if I sold that, they're paying a premium of about $27. When I add that to the strike price, I get an upward break even of about $147. So that's what the options market is pricing in for an expected move in this expiration cycle. And if I scroll up to that 47.48 strike price, I can see that the premiums there are around $5 or $500 per one lot. The delta is just above 30, and the implied volatilities in that area are trading at about 117%, so still quite elevated. Now let's scroll down and see what it would cost to roll the 110 strike put option up to the 120 strike put option, so at the money. That roll would cost a debit of $5.03. So if I turned around and sold a call for roughly $5.03, I could accomplish that roll for zero debit. And in order to do that, I'd have to sell a call kind of near that expected price movement. So I'm interested in comparing the October 17, 2025 options expiry to what I could get done in the November expiration. So I'm going to open up the November 21st, 2025 options expiry. These options expire in 57 days. And let's see what it would cost in order to roll the October 110 put to the November 110 strike put. So let's price out that trade, and that would buy us a little bit more time to be protected to the downside. And it would cost just shy of $7 for me to accomplish that roll. And if I were to finance that roll by selling a call against my 100 shares, if I wanted to do that for zero cost, it looks like I could sell the 180 strike call option and get that done for a small net credit. So let's populate that trade and just see what that would look like in the trade tab. Yeah, and the best I could do at mid would be about a 12-cent credit. So I'm not really sure that I want to go that far out in duration with this particular trade, especially given what's going on with the volatility here. So my preference would be to roll up the 110 strike put to the 120 strike in this October 17th expiry. And I want to sell an out-of-the-money call to help finance that. So let me scroll down here and let's just see what it would cost to finance that by selling the 150 strike call. And I could get that done for a 28-cent debit. So the reality is, who really knows what's going to happen with the price of OKLO? I certainly don't. And so rolling up that put and financing that roll by selling another call is worth it for me. So I just want to head back into the software, and I don't mind spending a little bit of a debit just to move the call strike price up a little bit. In this scenario, just given how wacky the market has been to the upside, why not give it a little bit more room to run? If I have to pay a little bit of a debit, so be it. So I'm going to go ahead and select the 160 strike call option. This means that I'll pay a debit of just shy of $2 to execute this roll. And let's send that through. And it looks like I got filled right away. So as you can see, I am short the 160 strike call option, and I'm now long the 120 strike put option. This improves my downside protection by about $1,000 relative to keeping the 110 strike put. And I was able to accomplish this for a small net debit. So I'm happy that I was able to demonstrate protective collar management in such a short period of time on such an interesting trade. Hopefully you find this helpful as you navigate learning protective collars. This video is for educational purposes only and does not constitute investment, financial, or trading advice. No recommendations to buy or sell securities are being made. All examples are hypothetical and for illustration only. All investments carry risk, including the possible loss of principal. Options trading involves significant risk and is not suitable for all investors. Past performance is not indicative of future results. Consult a qualified financial advisor before implementing any strategy and review your financial situation, risk tolerance, cost, fees, and tax implications. Options trading requires broker approval, and not all strategies are permitted in all account types. Returns shown are hypothetical and not guaranteed. Market conditions may change quickly, and results will vary based on market performance, timing, and execution. Read characteristics and risks of standardized options from your broker or at www.optionsclearing.com before trading options.